Hi everybody. In this video we'll work some Chapter 7 study guide exercises. As always, you will get the most out of these review exercises if you will please pause your video to do the calculations and write the journal entries for each question or scenario. Then start the video again to check your answer. If you got it right, you'll feel great. If you didn't get it right, that's okay. Now is the time to make and fix mistakes so you don't make the same mistakes on the upcoming exam. There will be a detailed analysis of each answer so you can understand and fix any errors you may make. Number 1. Sold $40,000 of merchandise on MasterCard debit cards. MasterCard charges a 4% fee and pays the company immediately for these debit card transactions. Please write your journal entry, then start the video again to check your answer. The correct journal entry is a debit to cash for $38,400. A debit to credit card expense $1,600, and a credit to sales for $40,000. The easy trick in remembering how to make a journal entry in this type of a situation is sales is sales. It doesn't matter whether there's a credit card used, it doesn't matter whether there's sales tax involved. The sales amount should be credited for the amount of sales given to you in the problem. So in this scenario, credit sales for $40,000, MasterCard they kept the 4% fee. They did not give the company $40,000. They gave the company 96% of $40,000. That's why there's a debit to cash for $38,400. And the difference is charged to an expense called credit card expense in this textbook. Now let's work a couple of bad debt problems. Byron Company's year-end unadjusted trial balance shows accounts receivable of $125,000. Allowance for doubtful accounts has a $400 credit balance, and sales were $450,000. In the first scenario, uncollectibles are estimated to be 2.5% of accounts receivable. Prepare the December 31st year-end adjusting entry to book the provision for bad debts. As explained in the textbook and explained in great detail in my instructor video lectures for Chapter 7, there are two ways to calculate the allowance for bad debts. One is from the balance sheet approach, which means we are concerned with the balance in accounts receivable and the balance in the allowance for doubtful accounts. And what we're calculating is the correct ending balance in the allowance for doubtful accounts. So take $125,000 times 2.5% of accounts receivable, and that equals $3,125. What the company is estimating is, of the $125,000 accounts receivable, $3,125 will never be collected. So the correct ending balance in the allowance for doubtful accounts is $3,125. It has a beginning credit balance of $400. That could be a small debit balance, but in this problem you're given it to be a $400 credit balance. Write the T account. T accounts are so helpful in figuring these things out. The $400 credit balance at the beginning of the year plus what equals $3,125. Well, obviously that's $2,725. That's your bad debt expense. This is not the bad debt expense when you're using the balance sheet approach and multiplying something times accounts receivable. So this is the bad debt from the balance sheet approach. Debit bad debt expense, $2,725. Credit allowance for doubtful accounts, $2,725. The other approach, again, as it well explained in the textbook and in my instructor video lectures, is to use the income statement approach and multiply percentage times revenue, sales revenue. If you're given credit sales, then multiply it times credit sales. If you're just given sales, then multiply the percentage times sales. In this question, it is what would be the journal entry if the uncollectibles are estimated at 0.7% of sales. The sales were $450,000. When you're using the income statement approach, multiply this credit sales, or just simply sales, times the percentage given, and that is bad debt expense. That is the bad debt expense. You don't have to use a T account. You don't care what the ending balance of the allowance is when you're calculating the bad debt expense. That is bad debt expense using the income statement approach. So I gave you the calculation. Go ahead and write the journal entry. It's the same exact journal entry. The same accounts are debited and credited. The amount is different. Debit bad debt expense, $3,150. And credit allowance for doubtful accounts, $3,150. So if you're listening, listen to this. If you're multiplying a percentage times accounts receivable, you must use this T account to calculate the correct ending balance in the allowance for doubtful accounts, and then the bad debt expense is whatever it takes to get from the beginning balance, whether it's a debit or credit, to the correct ending credit balance. Use the T account when you're multiplying a percentage times accounts receivable. If you're multiplying a percentage times sales, don't use the T account. Just simply multiply sales times that percentage, or multiply credit sales times that percentage, and that has calculated bad debt expense. Okay, here's a little essay problem for you. You might want to open your book and do a little bit of research before you write this out. Briefly explain the difference between the direct write-off method and the allowance method of accounting for bad debts. In your explanation, discuss the primary accounting principle involved and state which method is acceptable by generally accepted accounting provisions. I had a senior moment there for a minute. GAAP is generally accepted accounting principles. So go ahead and write just 1 or 2 sentences. Maybe 3 sentences should do it. And then start the video again to check your answer. Obviously, the words you used are not going to be the same words that I use, but the concept should be the same. Under the direct write-off method, bad debts are recorded when the event, such as bankruptcy, happens. It violates the matching principle that says we must record expenses in the same time period that we record the income. Under the allowance method, bad debt expense is estimated and recorded in the year the income was earned. The allowance method is required by generally accepted accounting principles if bad debts are material. Material means it's a large enough number that if it's wrong, it would change the user's mind about the financial statements. So if bad debts are $5, who cares? They're not material. But if bad debts are $5,000 or $50,000 or $500,000, they are probably material, and you must use the allowance method if you're going to state your financial statements in accordance with GAAP. Well, there are several more Chapter 7 exercises. However, rather than make this one video extremely long, I'm going to break the study guide into 2 video lectures. So that's all for this lecture. In the next lecture, we'll start with question number 5. See you next time.